This is Xenia here from Alexa Real Estate, and this is our property management podcast. And one of my actual strong passions is individual rights, including property rights. And one of the ways that we can defend our property rights is through minimizing the tax that we pay on the property and therefore maximizing the income that we get from our properties. And I am not a depreciation specialist or a tax accountant. I am a property manager, but fortunately I've got here on our show Omar Raslan from Key Property Depreciation. And welcome, Omar. Glad to have you here.
Thank you, Xenia.
And I just want to start, Omar, with asking you a question. Can you briefly just explain, please, the basics of depreciation and how they can apply to real estate investments?
Sure. So tax depreciation is something. It's a tool that your accountant can use to offset your income, which is generated from an investment property. So the ATO recognizes that properties will depreciate as they get older, and if we are able to calculate the level of that depreciation, both in terms of the capital structure or the plant and equipment, you can then use that to offset the income generated or the tax payable income from that property.
Okay, that makes sense. What types of properties actually benefit from having a depreciation schedule?
Yeah. So really all properties can benefit. Some obviously more lucrative than others. So there's a misconception that once a property is too old, it's not worth depreciating, or you can't generate a tax depreciation schedule on that property. And that's not actually correct. Yes, in terms of the capital structure, it takes 40 years to depreciate. So essentially, if a property that's 40 years old, there's not going to be much capital structure of the original property left. However, any improvements that have been undertaken in that property over the years, that can contribute to the amount that can be depreciated. So even if people come to me with a property that's built in 1940 or 1950, we will still be able to assess it and provide them with an amount that can be depreciated according to the ATO. Now, again, as I said, it might not be very lucrative, but it still can be done.
Okay, it used to actually be done a lot more before with the older properties. Is that right? And then the tax actually, the tax laws actually changed.
Yeah. So as I mentioned, 40 years is the life expectancy for the capital structure. So once a property is 40 years old, the original structure has already been depreciated. Now, there was a change in 2017 in regards to the plant and equipment. So tax depreciation is two main components: capital structure, which is your bricks and mortar and your plumbing, pipework, and your electrical wiring, and all the bits and pieces that put a property together, that cannot be removed or taken away from the property. Right, that's a part of the property that lives with the structure, lives and dies with the structure.
Mm-hmm.
Plant and equipment is all the other components that might have a shorter life expectancy, but can be removed from the property technically. So, for example, a hot water unit or an air conditioning unit. These things are considered to be plant and equipment. And where the law change was that in 2017. They stipulated that if you hadn't purchased the plant and equipment yourself for the intention for it being an investment property, then you can't actually claim it. So what this meant was people were purchasing property in pre-2017, and they were able to appreciate or enjoy, I should say, the depreciation of all of the plant and equipment. So ceiling fans, curtains, blinds, carpets, hot water units, air conditioning, all these sort of things, and they hadn't purchased them themselves. So now the law stipulates that you can only depreciate the plant and equipment that you yourself have purchased, and again for the intention of an investment property. So if you're living in the property whilst you purchase it, unfortunately, it can't be used. It can only be used if it's intended as an investment property.
Yeah, of course, you've got to have something to depreciate it against.
Mm-hmm.
Yeah, so as these laws change, what's a good way for people to keep up to date with laws concerning depreciation on their property?
Well, realistically, the information you should be receiving is from your accountant. There
Mhm.
are, I mean, you can keep up to date with web subscriptions. Tax depreciation is one of the most exciting things, so people don't usually subscribe for that to get that information. We're happy to keep all our clients and people that follow us up to date. So we try to regularly post anything, anything relating to tax depreciation with blogs and social media posting and things like that. But ultimately, the advice should really come from your accountant. And if they're not aware, then they should be referred to someone like us who we're working with within the industry.
Yeah, yeah. So I'm assuming you would be on top of all of these laws. So assuming I've got a rental property and I don't know anything about depreciations, can you give me an example of one that you've done where somebody has benefited from that depreciation schedule?
Yep. Yes, there was. I can think of a property that we assisted an interstate purchaser. They they purchased the property. It was a little tired, a little dilapidated, so it needed a bit of work. And but it had already had some pretty good amount of work spent on it. I think there was a new kitchen splashback. There was internal paint work done. There was an outdoor pergola and some other structures that were added to the property. So it had already had a certain amount of work done, but this particular purchaser, because they were interstate, they weren't going to be living in it for now anyway. I think their intention is to move here in the future, but for at least the next 5 years, they were going to put tenants in there, and they wanted to improve the property to make it suitable for the tenants. So they purchased it, and then they immediately started spending money on it. I think they put ceiling fans, new light fixtures, new hot water unit. They finished the painting throughout the whole property. There was some roofing concerns, so they improved the roofing and replaced a few issues. And it's very important not to confuse maintenance with improvements, because the ATO will not recognise maintenance and not allow you to appreciate the maintenance work. But when you're improving it to better the property and again adding to that capital value, then that's the sort of things that can be used. As a result, we determined that the capital improvements on that property to prepare it for an investment property was to the value of about $80,000, and some of the 80,000 wasn't the money that they had spent themselves. So this is the kicker, and this is the difference here. They enjoyed the benefits of the work that their previous owner had actually conducted. It was obviously recent enough, so still valuable enough to claim. And we had good information to assess the value adequately. And as I said, $80,000 worth. So when you look at it, 80,000. So I'll just do some quick calculation. So the depreciation, the way you calculate it, it's normally around 2.5%. Okay, that works out because it's 40 years to depreciate. So $80,000, essentially, what you're looking at is, sorry, do some quick sums, around 2,000. So effectively, their capital structure, they're able to offset their income by around $2,000 per year, just based on the capital structure. Okay. Then, in conjunction with that, they had, so I'm bringing it up here. Where is the equipment? They had in total around 35,000, sorry, $38,000 worth of plant and equipment that they were also able to offset. Now that depreciates at a different rate, very different to the capital structure, because it's not over 40 years. But for an example, their first year, their plant and equipment offset their income by about $5,800. So 5,800 plus the 2,000 capital structure. So 7,800 was their first year's depreciation that they offset their income with. And this is a property that's built pre-70s, I think
Wow,
pre-60s.
that's really impressive. That's really impressive. So you mentioned that maintenance can't be used because maintenance is just a normal tax write-off. So what process do you use to accurately decide what can be depreciated and what can't?
Yeah. So we have to work alongside with a quantity surveyor who, by law, is registered to create the values that go into, they can approve the values that go into the schedule and actually prepare the schedule. Now, that's one of our strategies. Obviously, is to look at similar quotes to get work done. But all we have to do is take into account the year that it was done. So if the capital improvement was completed in 2005, let's just say we're talking about polishing and restoring floorboards, or improving floorboards. The cost to do that these days might be different to what it cost in 2005. So we have to try to adequately get those sort of quotes. And then the surveyor is the one that will be able to sign off on that. So they'll understand the history, they'll know the amount of work that's done, and they'll be able to determine what the costings would be for the different year. The process to get that done though is we'll do an on-site inspection. So we'll assess the area, we'll determine what works hadn't been done. It's done by some qualified building inspectors, so they're aware of what to look out for and what sort of things had been done. The truth is, though, if we can't determine what year it was done, and normally that's through either research online, researching with the council, or speaking to the vendor or the agent, unfortunately that information may not be at hand. We may not be able to claim it because we can't take the surveyor's only going to really take a certain amount of risk with getting it wrong, right? So we try to keep it all legitimate and all feasible and reasonable. But that's what we'll do. On site, measure it, look at the scope of work, look at the quality of work, take plenty of photos, research as much as we can to determine how much of it was done and when it was done. And based on that information, the surveyor can then confirm what that depreciation value should be, and we can then apply that to the schedule. Ideally, we get our hands on the invoices. That's the ideal way to do it. But that's just not always possible. So we have to go by other means to determine what the value is.
Okay, so I've got a client at the moment where the house has actually been gutted and re-renovated. So we started off with the kitchen because the kitchen was damaged, and then he thought, I'll do the bathrooms. And while he was doing the bathrooms, he did the floors and the carpets, and then he thought, well, we might as well just paint it. So all of a sudden, we've got this brand new, newly renovated house. So do you think he would benefit of getting a depreciation schedule now?
100%. So how long ago, it can depend on when he's purchased it. And so how long ago did he purchase the property?
The property was purchased about 20 years ago, so it's not that new, but inside it's new kitchen, new bathrooms, everything.
So so he's purchased it 20 years ago. When will it become an investment property, like for rental? Or when?
No, it's always been an investment property. So we've had the same tenants in there for about 10 years.
10 years.
Tenants have just left, and he thought the kitchen looks like crap, so he wants a new kitchen. So yeah, everything's, so it's been an investment property all this time.
Perfect. Yep. No, that's great. So the schedule will actually begin when the property became available for tenancy. So that would be 10 years ago.
Mm-hmm.
So our schedule will begin in 2013, even though all this depreciation, the bulk of the depreciation is 2023. You have the first 10 years of zero or not much to depreciate. Right. It's definitely worth them doing it if they haven't already got a schedule in place, or even if they have a schedule in place with all this money spent on it, they're definitely going to. Do you know roughly how much they spent on it?
I think it was about 40 or 50,000.
So let's just say it's 40. We'll be conservative. Now, is that including the plant equipment? Like, is that including the oven, cooktops, range hood? Okay.
Yeah.
So let's remove 20% of that for plant equipment, which is a roundabout figure that So it comes to 32,000, right? 32,000 by 2.5% is around 800. So that means that just based on the capital improvements they've done, on that one capital improvement, then that's going to offset their income by $800. But then you've also got the plant equipment. So the range hood and oven and cooktop, they will all be depreciated, and they've got the maximum depreciation because they're brand new products that they've purchased specifically for investment purposes, right? So 800 on the capital structure, and then it would have to calculate it. But if let's just say the value was $8,000, so one way to look at it is a lot of these components might have a life expectancy of say 15 years, okay? And there's a different method of depreciating these components called a diminishing value method. A safe way to work it out is that it would offset, also it would depreciate by around 13% per year till it's down to zero. And so on a property on $8,000 worth of plant and equipment, it would be around $1,000, right? So 1,000 plus 800 capital improvements, then that's around 1,800 offsetting your income each year for the foreseeable future. It'll taper off and get a little bit less, as I said, it's diminishing, but yeah, definitely would be worth their while.
That's fantastic. He's definitely going to get a recommendation to you.
Thank you.
So what I'm hearing is a really good wealth building strategy. So do you see depreciation, like doing depreciation schedules and keeping on top of all of this, as a good long-term depreciation strategy for investors?
Yeah, definitely. Keeping this in mind also helps investors make decisions around what they will do with the property, whether they improve it, renovate it. Because, I mean, let's face it, you buy a property, you don't really want to have to spend anything on it, obviously, right? But when you know that there's a tax break in doing it, look, the other differences are some people might decide, well, am I going to tile this area or just put floating boards? I've got the main living space, I've been wanting to tile it for a long time, or should I just put carpet instead? Now that you know that they can be depreciated and the different effects of tiling versus carpet. So tiling is part of the capital structure. So that'll offset each year for at 2.5%, whereas carpets and floating floorboards will have the maximum depreciation within a 10 to 15 year life expectancy. So you're going to claw back the tax, or you're going to offset your tax much quicker and over that shorter period. So that for me would help me make a decision if I'm going to decide between tiling or floorboards, or floating floorboards.
Yeah, interesting, because SACAT uses those measurements with tenant damage as well. So if a tenant has damaged a carpet, they apply a depreciation to the effect to work out how much the tenant owes the landlord. So if they damage the carpet in year 10, they're pretty much they can pretty much walk away because it's already been depreciated. So that's really interesting. So when we're looking at brand new investors coming into the market, they've never had a property before, what advice would you give them, given for them to gain the maximum depreciation benefits?
Yeah. Okay. So, well, first of all, I wouldn't be too scared of something that needs work, needs change, needs fixing, needs new components, because a lot of people have that mindset that they'd rather buy something that has already gone through, had the renovation done, and what have you. I mean, I personally would like to do it myself. That's a personal thing. But the reason why you shouldn't be too scared of something that needs a little bit of work is because if you can be in full control of the work that's undertaken, so the renovating work or the repairs or the new items, new components, and then you can also enjoy some offsetting your tax or taxable income by choosing correctly and choosing the items and components correctly. So I'd say the advice would be, look, don't be too scared of something that might need a little bit of work. Now, if there is, if they is something that has already been renovated, so let's say it is a bit of an old property, I will try and take note of what you could tell had been done. Had there been additions, had there been changes, had there been, like I said, a rumpus room added to the back, or a pergola added to the back, or when was the last time the house was properly painted? When was the last time the floorboards were polished? I would do all this, and then I would request that of the agent or the vendor, and if possible. Now, again, not all of it's possible, but if possible, can you get that information or a timeline at least of when things were done? Because we can try and work out the cost, that's fine. But if we can at least get a timeline of when all these works are done, that's going to help you or help your accountant or your tax depreciator to determine what could go into the schedule.
Okay. I'm in the business of property management, so that means we manage the property, and I've been in the business for about 20 years. So sometimes we have a property with 2 or 3 different owners. So it's been sold to an owner who also uses it as an investment property, and then it gets sold to another owner. So I heard somewhere in there that you can actually do a depreciation on things that other people have done. Is that correct? So can one owner get benefits from what others have put into the property, if say for a new purchase?
Yes, you can. So as I said, the capital improvement that if it's capital improvement, unfortunately, the rules are strict on plant and equipment that can't be transferred over. But again, if work has been conducted on the property, then, and regardless of who spent the money on it, you got to look at it this way: it has improved the property at a certain point of its life. And the depreciation schedule is putting a value towards the improvement on that property or the capital value of the property. So if it's been improved, regardless of who's on the improvement, once you do your schedule, it'll take all of that into account. So yes, you can. Having said that, though, one thing I must mention is that with the tax depreciation schedules, they are not transferable themselves. So let's just say, person A purchases a property, gets a tax depreciation schedule done. The entity that owns the property, that's the name that the tax depreciation must be prepared into. And they're very strict on that too. So you can't have a misspelling on there. If it's, you might be John Smith, but it might be John Smith Property Holdings as an entity that owns it. That's the name that must be on the tax depreciation schedule. Once you sell it now to person B, and that's Jane Smith. Now, she can't use that schedule because it says John Smith Property Holdings when the entity that owns this now is, J Smith Property Holdings or Jane Smith Property Holdings, right? So you'll have to, she will have to do a brand new schedule. She won't be able to just purchase this schedule off somebody else. The information may be exactly the same. It might be almost identical, just with a different date range. Nonetheless, it has to be done again.
Yeah, and that makes perfect sense. Omar, have you seen what kind of mistakes have you seen investors make when it comes to this kind of stuff?
So, well, I suppose there's a lot of mistakes get made. I mean, I suppose hindsight's always a wonderful thing, when people are trying to improve their properties. Well, to make for a good depreciation schedule, as I said, ideally you'd have the invoices prepared and ready. A lot of people like to do work themselves and save money where possible and buy secondhand items. So they might have saved a certain amount of money, but what they got to realize is that they cannot claim any of that, or cannot, like if you go on Gumtree and buy secondhand, let's say, light fixtures. Or another example is if you're preparing an Airbnb property. So Airbnb, you obviously have to provide all the furniture. And it's clever, isn't it, to just go and buy secondhand furniture, because you're probably going to get it for 50% cheaper than what you would buy it brand new. In terms of tax depreciation, though, none of that can be claimed because those items are technically secondhand. You bought them for the first time, and they're in the property for the first time. You can't actually claim them. So you got to look at the amount of money you're saving by going around buying the secondhand items. That you're also totally missing out on any depreciation for those items. So you're going to weigh up how much you're actually going to be saving from using the depreciation. Look, you're probably still going to save more money from doing secondhand items, but it just makes much better business sense. And obviously as an owner, you don't really want too much secondhand items in the property, because that just means their longevity is going to be questioned, and the quality is going to be in question anyway.
And they need to look good as well.
Sorry, what was that?
They also need to look good, otherwise you're not going to be able to print it out.
Exactly, So So that's one bit of advice I'll give is, just, I know you want to save money some places, but consider this is going to be a way you can save a little bit of money. So you may as well do it properly, get proper tradespeople involved when you're doing any works to the property and so forth. Other mistakes is, just they're not keeping track of all the money they've spent on the property. I have some people that have bought a property 2 or 3 years ago, and they've just realised now that they haven't done schedule and they should get one done. They'll come to us, and we'll ask for the information. They've got no information to give us whatsoever, and we'll go and I like to think we do a pretty good job of determining what's happened and what's on, and try to put together a good time frame. But it's never going to be as good as if they actually just keep a proper log, keep track of everything they've spent on the property.
It sounds like when we take properties from private landlords, and some private landlords do it really well, and we don't see those because they don't need a property manager. But the ones that do need a property manager, we usually transfer them with all sorts of, things that have to be cleaned up after, letters written to the tenant, emotional appeals to why you're not paying rent, not handling it legally, all sorts of things. Which leads me to my next question. Are there any myths or misconceptions that you've heard regarding depreciation schedules on properties? Common things that people believe that you'd like to clear up?
Yeah, sure. So the one of the biggest ones that bothers me, I'd say as well, is that once a property is a certain age, there's no point doing a schedule on it. I know there's some people in the industry that will ask the first question to their client and say, how old's the property, and if it's pre 87, they just say, look, can't do a schedule, and leave it at that. So part of the service that we offer is we're happy to go and give a quick assessment of a property. So it could be over 100 years old. I'm still more than happy to try and determine what we could achieve out of a schedule. It's not going to be 100% accurate, but it's going to be, I think, a good and a good approximate on what it should achieve. And we don't charge for that. We'll go and we'll do the assessment. We'll come back to the client and we'll say, look, this is what we think it's going to achieve. Like, yes, it's an older property. It's not going to be as lucrative. You could probably achieve this much to offset your income. If they turn around and they say, yeah, that's not really lucrative enough, we'll say, yeah, fine, there's no charge or no obligation for them to proceed with the schedule, right? More often than not, though, we'll do our very best to identify the areas that can actually be depreciated, and they'll proceed, and we normally get good results. So the misconception there is that once a property's too old, you cannot do a schedule, or you should not do a schedule. Our opinion is that you should always at least investigate it, and more often than not, you can find something that can be claimed. And obviously this is all going to be, it only finds its way in schedule through a registered quantity surveyor. So it's all above board with the ATO. It's just a matter of unlocking things that can be claimed. So that's the misconception that I don't like. Another one is that accountants have to prepare schedules or must be involved in schedules. And that rule changed, several years ago, or many years ago now, actually. But accountants can't put together a schedule because you need to be a qualified quantity surveyor to be able to determine the values for construction components, and that's just not something that accountants are fully trained in. So I think once upon a time they were able to, but they can't now. So you do need to see someone that specifically handles tax depreciation schedules to be able to prepare one for you. Other myths or misconceptions. Look, as I mentioned before about plant and equipment, that is the rule, unfortunately. So determining what is and isn't plant equipment might be a bit confusing to people sometimes. Again, see a professional who's dealing with them day in, day out, and will be able to determine what can and can't be claimed. So with some plants and equipment, again, secondhand. Secondhand means it's been used and purchased for the first time for this property. So again, the concept about buying things on, say, Gumtree, for example, or Facebook Marketplace, it might be new in a box, but and never used. As long as you can prove that, right? But if the purchase date is 6 months before the property becomes an investment property, then the ATO is going to question that. Say, is this really a brand new item used for this? And there's a bit of grey area here because we have had some clients where they have purchased components, but the renovations were put on hold for 12 months, or something has happened. The property sat vacant for 12 months, because of whatever reason. And in those instances, we've put that forward and it's been okay, it's been successful. But more often than not, if the purchase date was, well in advance to actually being used in the property, then they won't accept.
Mhm. That's interesting. What about when a property is brand new? Say somebody purchased a property off the plan, and they're intended to use it as an investment property, and everything is brand new, newly built. Can an accountant do a depreciation schedule there?
Technically, no.
Okay.
Yeah, again, it's a new build is great because it's uh, everything can be claimed. So there's no question about the dividing up plant equipment. Sorry, it's
Yeah.
going to be. There's no question about what plant equipment can or can't be claimed or what have you. So that's the most lucrative example of getting a schedule done is through a new build. And the builders are usually good enough to provide you with documentation and costings of everything. So it makes the job for the quantity surveyor very easy. Still need a quantity surveyor to prepare a schedule.
Yeah, fantastic. That's great. Look, I am all for saving the money that you're maximizing the return on your investment properties. So, Omar, where can people find you?
Find us. Well, look, we're we're online. Best thing to do is to just give us a call, send an email, and the process normally to get the schedule done is we'll send an email with a list of questions, and that will be things like the name. Not. I mean, obviously, we'd like to know your name, but we need to know the entity name that owns the property, so the schedule is prepared correctly. And that also needs to have the address. So every entity that owns is going to have to have an address attached to it. So the address and then the property address. These things ideally will be different because, again, if the ATO sees that an entity that owns a property is at the same address as the property, then they're going to question, is this an investment property? It can get a bit tricky though when businesses are involved. So a business may own a property. So this is more, we're probably looking into commercial stuff. So yeah, again, there's a few little ways around it and to do it properly, but these are the bits of information that we're going to need. And then, the year the property was purchased, or like the settlement date, ideally, when it was available for rent. That's very important because that will be technically when the schedule begins. And then obviously as much information as you can provide us with in terms of what money or work was done to the property, what money was spent, sorry, what work was done. Now, if you cannot, again, our job is to find it all out for you, and we'll do our very best to try to uncover as much as possible. But again, ideally, whatever information you can provide just makes it easier and better and more chance of a more lucrative return. Yeah, best thing to do is reach out to us either via phone or email, and then we'll send an email. And once you respond with that, we get the ball rolling.
Excellent. So I will put your email address in the comments so people can find you.
Thank you.
Just before we go, is there anything that I've forgotten to say that you think is important for people to know concerning depreciation schedules or any comments or
Yeah, look, I think we provide a pretty good service and we can provide some pretty good information, but ultimately, go see your accountant for the advice. And if you haven't already done a tax schedule, ask your accountant why. If they don't have a genuine or a good answer for you, then I think just come and see us at that point, and we're happy to chat and discuss directly with accountants. There might be a reason because they might be using all the money that was spent on properties might have been claimed in another way or whatever, and that's fine. So we do like to be in contact with the accountants to make sure we're doing the right thing for the client and achieving the best result for the client. So the other thing is I think being in good contact with your property manager, being in good contact with your accountant, and you can bring us in via either one of those channels and we can make sure you get a good schedule.
Okay, well, I would love to hear what people have thought of this podcast. Thank you very much for coming on. And I've been working with you for quite some time, I think, since 2017. So I've seen what you've done. And thank you for coming on, Omar.
Thank you, Xenia. I really appreciate it. And yeah, likewise, it's been great working with you over the years as well. Thank you.
Thank you. Thanks.
All
Right.
that's it.
Bye, everyone. Bye.